Welcome to today's What Will Move the Market show. I'm your host Prem. It's Thursday, February 12th, 2026, and here is everything you need to know as the markets open for today. Overnight on Wall Street, it was a fairly subdued session with a slight tilt to risk-off. The Dow Jones Industrial Average slipped about 0.13% to close near 50,121, dragged lower by weakness in a few heavyweight industrial and financial names. The S&P 500 was virtually unchanged, down just 0.01% and finishing around 6,941, signaling more of a pause than a pullback. The Nasdaq 100 actually managed to buck the trend, rising about 0.29% to close near 25,201, supported by selective strength in large growth and AI-linked stocks, even as some high flyers saw profit-taking. Under the surface, sectors tied to the real economy like financials and some cyclicals lagged, while parts of tech and communication services held up better. The bigger narrative in the background is that strong recent US jobs data and still firm wage growth have tempered hopes of aggressive and early Fed rate cuts, keeping bond yields elevated and making equity investors more selective. In extended trading, attention stayed on corporate earnings and guidance, where any disappointment on future growth continues to be punished quickly, reinforcing this show-me mood on Wall Street. For Indian investors tracking their favorite companies listed overseas, the overnight message from Indian ADRs is mildly negative overall, especially for IT and private banks. Infosys ADR closed at about $15.75, down a sharp 5.21%, which is a clear signal that the street is in profit-booking mode on IT after the recent run-up, and that Nifty IT could see some pressure at the open. HDFC Bank's ADR finished at roughly $33.21, lower by 2.29%, reflecting continued digestion of its recent performance and concerns around margins and loan growth at elevated valuations. ICICI Bank's ADR, by contrast, was almost flat, easing just 0.10% to around $31.12, suggesting more of a sideways consolidation than any change in the underlying bullish view. Reliance Industries' London-listed GDR closed near $64.8, unchanged on the day with a 0% move, which points to a neutral cue for the heavyweight energy and telecom bellwether. Put together, the overseas trading action is hinting at a softer start for large-cap IT and private banks, while Reliance-driven sectors may open closer to flat. Shifting the lens to Asia, the early read this morning is a touch cautious with pockets of weakness. In Japan, the Nikkei 225, based on its latest close, is just under 57,800 at about 57,762. Down roughly 0.65% as traders logged in some profits after a powerful multi-week rally that had taken the index to fresh record highs. The move suggests that the so-called Takaichi trade, built on expectations of continued fiscal support and pro-growth policies, is taking a breather rather than reversing. Over in Hong Kong, the Hang Seng Index's latest indication is around 27,125, down about 0.21%, as tech and property names came under mild pressure again, amid lingering concerns over China's growth and regulatory backdrop. On the mainland, the Shanghai Composite Total Return Gauge is close to 4,739, up about 0.09% as of the last close, reflecting a very modest uptick driven by selective buying in metals and state-owned names, even as broader sentiment remains cautious. At the time of recording, these Asian moves are based on the most recent closing and early code data. Live trading will add more color as the morning progresses. Closer home, GIFT Nifty is giving us a fairly clean cue for the Indian Open. The GIFT Nifty 50 futures are trading near 25,994, up about 0.08% or roughly 22 points from the previous settlement. That points to a mildly positive start for the Nifty 50 cash index, more of a gentle range-bound upward bias than a big gap. Given where we closed on Wednesday, this suggests the market is likely to open near the upper end of its recent consolidation band, rather than starting a fresh trend on the opening bell. On the global macro and geopolitical front, two themes are particularly relevant for Indian markets this morning. First, the combination of strong recent US labor data and sticky wage trends has kept the Federal Reserve's tone cautious, with markets now pricing in a slower and more measured rate cut cycle instead of the early, aggressive easing that some had hoped for at the start of the year. That keeps US yields and the dollar relatively firm, which in turn can cap risk appetite for emerging markets in the short term, even if India remains a preferred structural story. Second, In commodities, oil prices have stabilized but remain a key risk variable. US WTI crude is hovering around $64.88 a barrel with little change on the day, reflecting a stalemate between concerns over Middle East tensions and supply disruptions on the one hand, and softer demand indicators and inventory builds on the other. That level is not yet alarming for India's macro, but if geopolitical risks flare up again and crude spikes, it would feed quickly into inflation, the current account, and sentiment in energy-sensitive sectors. Back in India, the domestic market is holding firm near life highs, while clearly respecting a consolidation pattern. On Wednesday, the Nifty 50 closed just shy of the 26,000 mark in the mid-25,900s, while the Sensex finished in the low 84,300s with a very small gain, signaling a market that is pausing rather than reversing. Sector-wise, IT underperformed on the back of those weak global cues. Financials and autos saw selective buying interest, and the broader mid-cap and small-cap space was mixed, with stock-specific action dominating over index-level moves. Foreign portfolio investors remain net buyers in the cash market on the 11th of February, with inflows in the ballpark of 900 crore rupees, while domestic institutions were modest net sellers, booking some profits after the recent surge. That combination continues to underscore a constructive backdrop where foreign money is leaning back into India even as locals take money off the table at higher levels. From a policy standpoint, the Reserve Bank of India's latest Monetary Policy Committee meeting earlier this month chose to keep the repo rate unchanged at 5.25% with a neutral stance, raised its growth projections modestly, and acknowledged slightly higher inflation primarily due to the sharp moves in global commodities, but stressed that India remains in a sweet spot of strong growth and manageable price pressures. Let's turn to the technical picture, because that will likely drive intraday setups today. After Wednesday's close, Nifty 50 is perched near the top of its recent range, just below the psychologically important 26,000 level. Short-term charts are highlighting a trading band with immediate support in the 25,800s and key support a bit lower, around 25,500. As long as the index holds above that broader support zone, the short-term trend remains constructive, and dips are likely to attract buying interest from both traders and investors. On the upside, the first big hurdle is that round 26,000 mark, followed by a resistance pocket in the 26,100 to 26,200 region. A clean break and close above that band, supported by volume, would signal that the market is ready for the next leg higher. Failure there would keep us in a choppy consolidation with frequent intraday swings. Bank Nifty, which recently closed around 60,600s, continues to look relatively stronger on many technical setups. Immediate support is seen near 60,600, with a more important floor around 60,000. The index has repeatedly found buyers on dips into that broader zone. On the upside, resistance is clustered near 60,800, and then again closer to 61,000. A decisive move through those levels could unleash fresh momentum in banking and financials, while a slip below the immediate supports would open the door for a short-term pullback towards the lower part of the recent range. For day traders, the takeaway is straightforward. This is still a range-bound market near all-time highs, so it pays to respect these clearly defined levels. Avoid chasing moves in the middle of the range, and wait for price action to come to your zones. In commodities, the cross-currents are worth noting, but not yet disruptive for equities. US crude oil, as mentioned, is sitting around $64.88 a barrel, with essentially no move on the day, reflecting a delicate balance between geopolitical risk premia and demand worries. Gold, after a huge run to record levels earlier this year, has cooled off a bit, with the latest quote near $5,061.429 an ounce, down about 0.46% overnight. Silver is also in pullback mode, trading around $83.012 an ounce, down roughly 1.48%. That combination suggests that the frantic safe haven rush we saw earlier is giving way to a more two-way market where metals are consolidating rather than surging, which takes some pressure off central banks and inflation expectations. Natural gas is softer as well, hovering near $3.157, while base metals such as copper remain broadly supported by long-term themes like electrification and AI data center demand, even if their day-to-day moves are choppy. For Indian equities, this commodity setup is a mild positive for rate-sensitive sectors, but something energy and metal names will continue to react to on a daily basis. So how should you think about your day plan in this environment? With Nifty and Bank Nifty both near the top of their trading bands, and Gift Nifty signaling only a small positive start, this looks like a day to trade the range. not to bet aggressively on a one-way breakout. Avoid getting carried away by the opening tick, especially if we see a small gap up on the back of global cues. Instead, watch how price behaves around those key support and resistance zones before taking positions. If you are an intraday trader, consider keeping your position sizes moderate, placing stop losses just beyond the important levels rather than too tight, and resisting the temptation to average into losing trades simply because the broader trend still appears up. For investors with a slightly longer horizon, the big themes remain intact. India's growth is solid, the RBI is on a cautious but supportive pause, foreign flows have turned constructive again, and the evolving US-India trade framework plus domestic capex and manufacturing pushes continue to favor quality financials, industrials, and export-oriented stories. The focus should be on sticking with fundamentally strong names, using bouts of volatility to gradually build positions rather than chasing every rally. And for anyone newer to F&O, treat SEBI's stricter rules as a friendly reminder that derivatives are tools for hedging and disciplined strategies, not a quick ticket to easy money. That's it from me on this morning's What Will Move the Market show. Stay tuned for the evening wrap, where we'll break down how these levels actually played out through the day. Send in your questions and topics you'd like us to cover, so we can make this show even more useful for you. And don't forget to subscribe to this podcast so you can join us every market day. Until then, trade safe, stay disciplined, and have a profitable Thursday.